Alright, welcome back to our investor series at PropertyLimBrothers. Today we are going to talk about 4 things that we can learn from the history of growth in Singapore real estate prices. Let's go. What are the key things and what's so unique about investment? What are some of the pros and some of the cons? Should I buy a new development or a resale one? Alright, so there was this article that our editorial team has written at the onset of 2022, and this article is named as the history of growth in Singapore's real estate market. If you have not seen it from our PLB Insights, you can head on to our website at www.PropertyLimBrothers.com, click on the Insights button, and there was this article that was very interestingly written because our team managed to find some of the very old photographs from the heydays of Singapore, especially during the 1960s and 1970s, to help everybody visualize how Singapore's real estate market has evolved. Even the onstart of SIT, which was Singapore's investment trust, because that was during that time that HDB has not even been formulated, all the way from 1950s to 60s and until the year 2022 right now. We bring you through some of the very interesting timelines that our Singapore property market has evolved over the years. In Singapore, a lot of history tracks back to our formation of public housing. In the whole world globally, a lot of countries look up to Singapore whenever it comes to our public housing policies, because that has been one of the core factors that has allowed almost every resident to own a home at a very, very young age, as long as they settle down and build a family. If not, by the time you are age 35, if you are single, you have the capability to purchase your own public housing flat. That was also one of the core reasons why our economy is strong. That translates to a stronger GDP. Every resident thus in Singapore is able to settle their own housing accommodation without having the need to rent for a prolonged period of time. And that's one of the core reasons why our economy and workforce has been stable throughout our past 56 to 57 years as we count back from 1965, the year that Singapore got its independence. And I'm going to leave you to read the article and to enjoy the different photographs right here. So what we're going to do today is that we're going to derive 4 different things that we can all learn from the timeline and the history of Singapore real estate prices when it comes to our public housing as well as our private property pricing. So these are the 4 different lessons that we can derive, and let's have a look at point number 1. So point number 1 is that we can never go back to the price that was in the past. So sometimes when we meet our clients, we see some questions whenever it comes to maybe our Nuggets on the Go or Investor or Ask series. Some of our audiences will ask us, hey Melvin, do you think that Singapore real estate prices can go back to maybe just about 10 years ago in terms of per square foot pricing? The straight answer is that definitely it is no. What is the key fundamental reason is that we have already evolved from a developing country to a developed country. So in the rule of economics, this effect is called the convergence effect. It's also called the catch-up effect. So what is the convergence or catch-up effect? Basically, a developing country compared to a developed country, developing country tend to increase faster because of a diminishing marginal returns theory, because the developing country is adopting at a faster speed and at a more massive approach when it comes to production level, efficiency level, building up its industrial factories, building up its economy, and they can actually learn from developed countries on how things are done at a faster pace. Thus, developing countries usually have this convergence or catch-up effects that they tend to catch up faster towards developed countries. And once countries has reached its developed status, basically in terms of marginal and diminishing returns theory, they tend to plateau off and increase in terms of their GDP at a much slower rate. And of course, that's not saying that things won't change, because we are moving to a new season right now compared to the past industrial revolution. Is that now we're heading into the new era whereby there's metaverse, cryptocurrency, there's blockchain, and of course there's a whole new era altogether. But when it comes to speed of growth, whenever it comes to real estate prices, we can see that vast difference when it comes to developing and developed countries. So right now, of course, Singapore is in a developed country status. It's very difficult for us to go back to the 1980s or 1990s, or maybe just the year 2000s, whereby condominium prices at $500 per square foot or $600 per square foot. So it's almost impossible to hit back to that level. In fact, if we want to just go back to a few years ago, whereby you can still get some of the condominiums at maybe at about $800 per square foot or $700 per square foot, it's almost impossible to find anything right now. The key reason is that we are at a different evolvement, we're at a different status right now as a country level. So why is this important is that we need to look forward, especially if you are planning to purchase your first home or you're planning to purchase your first property for investment. Looking forward is extremely important, because if we were to keep thinking about, hey, can we go back to the heydays, then sometimes what's going to happen is that if you were to wait out and hoping for that crash to happen, you're going to miss out on the market even further as prices steadily climb upwards. And later we'll talk about some of the key fundamental reasons as well on why prices are gradually increasing year on year, partly because of QE, partly because of inflation, partly because of a lot of different positioning factors that Singapore is in. Now, what is the second thing that we can derive from the history of Singapore real estate prices? Let's bring out the chart right now. Usually, it's very hard to find price chart that is slightly older than the 1990s. Usually, we look at prices that are starting from 1990s all the way until today. And you will see this very significant graph which happened in the 1996 and 1997. You will see this huge rise suddenly, and then there's a huge drop in terms of the private residential price index. Now, in order to understand this graph, let's just track back some of the key events that happened. So 1996, 1997, that was the season of the Asian financial crisis. And of course, that very season brought a lot of property prices downward. In fact, I have known of property owners that just purchased properties right towards the tail end of 1995, 1996 and new launches, or maybe in the resale market. And the very moment Asian financial crisis happened, the price dip was so significant that it took them close to about 10 to 15 years to recover in terms of the pricing that they bought. So some of the property owners in certain projects, when they suffer from that crash, it took them close to about 15 years later until the year probably at about 2010 for the price to hit back or surpass back to the 1995, 1996 pricing. And that Asian financial crisis was one of the learning lessons, because after that key event, our government got smarter in terms of cooling measures, and we can see the implementation and the rapidness and the sensitivity of cooling measures implementation over the past 10 years. And later we're going to talk about what has happened right now. And after that key event, another major event happened, which was the September 11. So September 11, that was also in sync with the dot-com bubble, because you will see there was this little rise again towards the dot-com bubble. Right after that crash from the dot-com bubble, September 11 set on, and then you will see a very long plateau in terms of private residential price index. That particular season was during the SARS period, and that was during the 03 and 04 season. Right on after that, just about 2 years later, 2006 was one of the key catalysts in terms of the price rise, and that price rise was pretty steep. It went up pretty fast. That coincided with global recovery. It also coincided with Singapore announcing our casinos as well as our integrated resort. So everybody got very excited. Singapore is reaching that developed status from 06 season. It went up all the way for a straight 2 to 3 years. And then during October 2008, what happened was the Lehman Brothers crisis set in. In short, that is called the subprime crisis, whereby there was a lot of, I would say, low-grade mortgage-backed securities that was being repackaged into grade A securities. If you have not watched The Big Short on Netflix, you can watch that particular show to understand about the 2009, to understand about the 2008 October crash. But that crash in Singapore was pretty short-lived. In fact, it took only about 4 months for the crash to happen. Something to note during this chart is that we want everybody to put your notice on the low amount of property transaction volume that happened during the Lehman Brothers crisis. And later we're going to talk about this effect. And this particular effect is called the disposition effect. And we will touch on later on what is the disposition effect, because that's a human psychology effect whenever price drops, and it's also a human psychology effect whenever price rises. So we behave differently when price rise, and we behave very differently when price fall. After that quick recovery, in fact, property prices went all the way upwards from 2009 April, and that was also the singular season that we start to see landed property prices surpassing condo prices. Because during that season, somehow consumers in the market, property buyers in the market realized that there was like a huge disparity between landed prices and condominium prices, in the sense that they were too close to one another, and it doesn't make sense in terms of land per square foot. When you look at a pure landed, maybe an inter-terrace, at that time it was only at about $1 million, compared to a condominium is at about $800,000. So the price gap is very, very close. So thus, that gave rise to the realization that landed property prices might be undervalued, and we start to see that gap, and we call it the chasm gap during one of our Nuggets on the Go series, whereby landed prices and condominium prices then start to split up, and they have never touched each other ever since 2009. Fast track to 2013, because prices were rising and recovering very rapidly from 2009 to 2013 for a good 4 years. Our government took notice of what is happening in the market. A lot of people are buying their second and third property for investment. They're also buying it to flip as well. So there were a couple of cooling measures, and from that season onwards until today in 2022, what is happening is that we have more than 10 rounds of cooling measures that's governing people from speculating in properties, because our LTV for our second and third property, so on and so forth, has been so-called safeguarded. Seller stamp duty has been implemented so that you cannot immediately buy a residential property and then the next day day you try to flip it to another buyer. You have ABSD for your second and third properties to prevent us from over purchasing properties for our second and third property. And thus, the residential market then has seen a very tepid growth over the past 8 to 9 years. So since 2013 until 2022, what you can see is that there has been like a sharp rise from 2009 to 2013, and then a slight dip after 2013 because 2013 was one of the ultimatum of cooling measures, especially when it comes to the total debt servicing ratio, because the income qualification for loans and mortgage loans got so stringent that a lot of people took about 1 to 2 years to get used to the new regulations, the new debt servicing ratios, as well as for everybody to clean up on their credit card debts and all that in order to qualify for mortgage loans. So there was a dip, it started to climb up gradually back again until today's prices, and the latest catalyst was during the COVID period. So ever since the onstart of 2020 until today, which is about 2 years already, prices has been rising very rapidly. In December 2021, there was a final round of cooling measures that just recently came out about 2 months ago. So that's it for the entire timeline. And going back to our lesson number 2 is that what can we derive from this timeline is that we need to understand the reasons behind the price rises and the price fall. Because if you are going into property investment, if you are wanting to buy a property for your family, be it your first or second one, if you were to understand the key rationales from 1996 until today, and what are the fundamental reasons that causes the price to escalate, and what are the fundamental economic reasons and internal reasons that cause prices to drop, then you will be a better investor because you will not then purchase with emotion, you will know how to purchase with reason, you will know how not to speculate, and you will know how not to time the market. Because only by truly understanding the rise and fall, then we can be a better investor. So let's look back at some of the reasons of why price has risen. So the reason why price has risen during the 1996 season was that there were a lot of speculation. That was during that season whereby our olden days investors, when we started real estate in like 15 years back, some of our investors, they used to tell us that, you know, there people were selling queue numbers. So people were like queuing up at show flat just before the show flat is open, and then they were selling their queue numbers to people at the back. This just to allow you to gain a foothold in order to purchase. And can you imagine that your queue number can actually sell for a 5-digit figure just so that somebody can get a chance to purchase? Because back in the days, there were not a lot of private property launches. Just having the opportunity to purchase a new launch will sort of guarantee that you will be able to flip the property in the sub-sale market. So back then, that was the season. During the 1996-1997 period, a lot of all this flipping and sub-sale were ongoing. And when the crash happened, a lot of people, of course, suffered. And that was also the realization whereby a lot of people were suffering from margin calls. So what were the margin calls consequences? Basically, in the past, you were able to get loans as high as up to 90% or even up to 95% back then. So all you need is 5% cash. You can walk in, the bank will finance the balance 95%. And what's going to happen is that you don't need a lot of firepower to purchase properties. Basically, you just need the ability to show the bank that you can repay the loan. And in fact, back then, there was no TDSR. Loan qualification was extremely relaxed. Banks were very aggressive in loaning investors and buyers to purchase properties. So basically, a lot of people are buying properties, their first, second, and third with 5 to 10% down payment. So when property prices dived down for more than 20%, what happened was that banks started calling the buyers that have very minimum down payment to ask them to top up the margin difference when it comes to the down payment based on amount of percentage drop. So what does this translate in today's lesson is that right now, if you want to buy any property, you need to come with 25% down payment, which is a significant amount. 1 million, you already need 250,000. You need also the stamp duty, which will then translate to a total of about 274,600. For the banks to call you to ask you to top up your down payment, the market needs to dip by at least 25%. Truly, if the market were really to crash by 25% in terms of property prices, I think probably that will really be doomsday already, because if anything needs to crash 25%, it's almost like the end of the world. So banks and MAS recognize this because by having a stronger buffer, it allows MAS to ensure that buyers really have the capability to have that amount of savings, to have that amount of prudency, to invest in real estate. In order for you to put in 25%, you definitely will need to have a little bit more savings to buffer for another 12 to maybe 18 months of installment. So usually it takes prudency for that to happen, and 25% is an extremely high amount, and you can only leverage 75% from the bank. Bear in mind, your second property, you can only loan 45%. That means that you need to down 55%. So all these are implementations to ensure that basically when it comes to the buffer that a buyer and investor need, this is to ensure prudency compared to the heydays, and thus margin call definitely or likely will will not happen in today's market. And when it comes to 2006, the global rise in property market in the US, of course, that attributed to the subprime crisis, but in Singapore, there are a lot of fundamental reasons because Singapore was developing heavily into its URA master plan. It was also developing Sentosa, it was developing the IR, it was developing Marina Bay Sands. During that season, a lot of investors, when they look at Singapore, Singapore is secure, it's safe, good governance, and we are a small island, our land is so scarce. So basically, when you look at 2006 to 2009 season, there was a lot of attention on the Marina Bay Sands property. That was also the season where the sale at Marina Bay, one of the first debut to come out in the CBD zoning as a very beautiful residential project, took on speed from CDL. Launch was an instant success. In fact, Tower 1 and Tower 2 prices was such a vast difference because Tower 1 was instantly sold out below $1,000 per square foot. Tower 2 was above $1,000 per square foot price at about $1,200, $1,300, and that was also sold out as well. In fact, the first owners of the sale at Marina Bay Sands, a lot of them became millionaires right there from this project because the price gain was so significant. Nobody believed in buying a 99 years residential project in the CBD zoning because that was the first one, but those who did, because they made significant price gain. The same goes for Sentosa Cove as well. The first project was the birth at Sentosa Cove, followed by some of the other projects like Azul, Oceanfront and stuff like that. And of course, a lot of first-hand owners earned significant gains for the condominiums as well as the 99 years landed right around Sentosa Cove. And that was during that season that price gain was enormous. After the 2009 Lehman Brothers crisis, that resetted just for a short period of time and then it rebounded back all the way to 2013. So the rebound happened because fundamentally Singapore was having a lot of fundamental reasons on its real estate market, and 2009 to 2013 was actually a very huge rise to let the prices be on par with our growth into a developed country. To understand that would then let us realize that, because if we were to ask ourselves, will we enjoy such gains as in during the 1996 season, 2006 season and 2009 season in today's market? Can we still invest in any resale condominiums or new launch condominiums and enjoy maybe like a 40, 50 or maybe like 100, 200% gain once we collect our keys? So that is something that we want to address. And when we look at price falls, we also need to understand why did price falls happen. 1997, because of the global situation. 2008, global situation. 2013 was internal reason, because 2013, after the onslaught of a host of cooling measures, technically speaking, we were the ones that brought our own prices down. The fundamental change was actually being further explained also in one of our Nuggets on the Go. It takes a full episode to explain that, but to summarize it for you, that was because of the main measure of TDSR plus ABSD. Instantaneously, buying demand drop, transaction volume drop, and instantaneously developers then switch strategy from developing big units to small sizable units in order to adhere to the new TDSR quantum. So you will see that dip from 2013, and then it took a bit of time for the market to react, to get used to, and by the time we hit 2016, 2017, the supply dried up in the market, en bloc happened in 2018, and then we were on an uptrend once again. Understanding the reasons between price rise and fall, to summarize that, let's look at this term called the disposition effect. And we want to zoom into 2008 to 2009 to understand why is it that when price fall during the Lehman Brothers crisis, there was so little transaction volume when price dropped. But when price rises all the way from 2009 to 2013, as you can see from the volume bar chart, why was there a huge amount of volume that happened? Now the key reason is because the disposition effect explains that. Similarly, if let's say we were to invest in the stock market, let's take that just for an analogy and an example. Let's say for example you invest in two different stock counters. One counter, you invest maybe $100,000, but it has outperformed and it has brought your investment with a paper gain of another $100,000, and your total paper value right now is at $200,000 for stock number A. Stock number B, you invested $100,000 as an initial investment. After 1 year, it didn't perform. It has dropped your investment by 50%, and now your balance paper value is at $50,000. So over here, you have a paper loss of $50,000. The natural reaction is that, for example, after 1 year, if you decide to bring your family for a holiday, you're thinking that, hey, I don't want to touch my own savings. I want to use some of my gains that I made through my investment in the equity market. What is very likely to happen is that you will not sell off stock number B, because the moment you sell off, you realize the immediate gain of your paper loss of 50,000. What you might actually do is that you might sell off stock number A in order to realize and lock in your gains of 100,000. You might sell it off to have a balance of 100,000 as your base value, because that was an initial investment. You might take out the $100,000 to enjoy for your holiday, for your family. And this is what we call the disposition effect, is that investors tend to sell their winners and tend not to sell their losers. And that is also the same reaction that might have happened during the 2008 season, because prices has dropped. Investors and homeowners, they were staying in their private properties, or they're holding on to 2-3 properties, and they can still rent out, they can still utilize their property, they're living in it, their kids are studying nearby. Even for their second and third property, they can continue to rent out their property, and there's no need and no rush for them to exit the market as long as they can service the monthly mortgage installment to ensure that the bank don't repossess back their property. For their first, second, and third property, they already have maybe about 20 to 25% down payment that's being invested into the property. And during that season, there were already some cooling measures that has happened during that season. So people are used to holding their properties. There's no need for them to fire sale it. And that's why when price dip, transaction volume in the real estate market tends to be very little. Very few people see the need to sell them. If they really need to sell their property, the core fundamental reason could be that they want to take advantage of the market. Sell now, although they sell a little bit lower, but they get to buy a bigger property at a lower price. And that's what we call the disposition effect, because when we flip over to see 2009 or 2013, why is it that transaction volume actually escalates when prices are moving up? Because people always have this term saying that, hey, when you sell high, you buy high. That is extremely true. But when prices are moving up and you sell your property, a lot of people view it as a sense that they can lock in their paper gain and use that paper gain to down pay for a bigger property. Because when price tend to rise, it also does make sense to buy a bigger property, to upgrade into the bigger property. Because when we look at two different comparisons of property A and B, if this is 1,000 square feet and this is 2,000 square feet, a $100 increase in both properties, let's say they're in the same district, the same property type, it's just that their sizes are different. There are a lot of different reasons whether they are freehold or 99 and things like that. Let's just take, for example, both has almost the same inherent factors, is that $100 per square foot rise in both prices. This 1,000 square feet is going to increase by 100,000, but the 2,000 square feet property is going to increase by $200,000. So when price tends to increase for a prolonged period of time, it does make sense to switch on to the bigger property faster so that we enjoy the price gain much faster as well. So that is also one of the reasons why a lot of people tend to sell and purchase properties when price graph tends to scale upwards, and thereby seeing the large amount of volume that has happened during 2008 to 2013. So that's reason number 2, disposition effect. And let's head on to reason number 3 and follow on the last one. We'll wrap up with reason number 4. Now, reason number 3 is that if we understand where Singapore is going, we will then understand how prices might go. So basically, a lot of homeowners and home buyers, being Singaporeans ourselves, we may think that, hey, is our price really too high right now in Singapore? Should I wait out? You know what's going to happen to our real estate price in the next 5, 10, 15, 20 years? Let us just maybe look at the entire Singapore with a helicopter vision. Now, the very first thing is that we always share with our clients and our audience is that as true blue Singaporeans, the very first thing is that all of us need to own our own real estate in our own homeland. Because the fundamental reason that Singapore is land scarce cannot escape reality. Our land is only so big, there's only a fixed amount of land that we can go. There are only 340,000 private residential condos and apartments. There are only 75,000 landed properties. There are only 1.2 million HDB apartments right here in the entire island right now in the year 2022. And if you have the ability to upgrade to a private condo or apartment or to a landed property, then all the more you need to do so if you have the capability and prudency to plan. Now, the key reason is because if you don't do that, foreign investors and foreign purchasers, they are all eyeing our properties. And since the start of time for the past 20 to 25 years, because the fundamental reason and rationale that Singapore is a true blue island and city to invest in cannot escape reality. Now, let's have a look at a host of reasons. We're not going to dive into extreme reasons. Every reason has its own strength, and one core reason is because of our currency strength and currency value. So just give you an example. Foreign investors in Indonesia, foreign investors in Malaysia, foreign investors in our Southeast Asia country, as long as they are in a country whose currency strength year on year vis-a-vis our Singapore currency strength is weaker or is going towards a disparity trend, then all the more they're attracted to invest invest in our real estate right here. The key reason is because they will just need our property price to remain the same for the next 10, 15, 20 years, and the currency disparity will continue to increase for them. And anytime they were to sell the property back at the same price, they don't even need the property price to appreciate, and they were to translate back to their own currency, they will see a vast difference in terms of appreciation of their native currency. And that fundamental reason will just propel foreigners to invest in our properties year on year non-stop. Now, the second reason is that Singapore is land scarce, and yet our economy is growing and our population is growing rapidly. We took a standstill in the last year because of COVID, because of immigration policies, but we're still on track to 7 million in 2030. So if we look at 7 million in 2030, we also need to understand that 7 million is not just a figure, because 7 million is being split into two portions. Every 2% that you meet in Orchard Road, basically you just throw a stone. Every one out of 2 people that walks in Orchard Road, one is going to be a Singaporean, one is going to be a foreign citizen. And that is because out of 7 million in terms of population in another 8 years time, 3.5 million are going to be Singaporean, 3.5 million is going to be a combination of permanent resident and foreign citizens. And that is the reality. And when we look at what is the availability of housing accommodation choice for PRs and foreign citizens, is that they can only rent or they can only purchase condominiums and private apartments. They cannot touch HDB properties because there are so many policies governing it. Even for PR to purchase HDB properties, that they need to be married, they need to have at least PR status for 2 years, or they have to marry a Singaporean. So basically, you are looking at half the population aiming for the 340,000 condominiums and apartments. You have another 3.5 million that's eligible for the 1.2 million HDB properties. And when we just look at demand and supply, instantaneously you would know that private residential properties are low in supply and high in demand. And just for that fundamental reason, when it comes to population, you already know what to invest in. And last but not least, before we end off, reason number 3 is that Singapore has so many different modes that's being built around it. More than 10 rounds of cooling measures right now, priced into our property price index, and our price is not dropping. In fact, our price is still skewing up year on year, month on month, on a very gradual and healthy basis. And thus, we have close to about 10, 11, 12 rounds of cooling measures plugged into it. How can our price fall? Because the moment if there is going to be any external economic events that is going to threaten our price, what's going to happen is that the government can always just release some cooling measures to ensure that our cooling measures will resuscitate the prices back to a healthier level. And let's head on to point number 4. And point number 4 is that price gain is definitely different now. And it's very hard to head back to the past whereby you see very, very significant price gain the moment you enter into any new launch show flat and purchase any properties rather than any launch. Because nowadays, you need to definitely do a lot more research and homework to hunt for the right property with that disparity and try to forecast in 3, 5 years or 10 years time whether will there be a price gain potential. So now it's not a matter on whether does new launch ascertain a higher probability of price gain or does resale ascertain a higher chance of price appreciation. It's not so much about whether is it new launch or resale, but it's about a question about which new launches and which particular resale type of property will have a higher chance of appreciation. So it's more about the specifics rather than the generalization. And also it's about looking at the disparity between different types of properties on whether is this season the season for a fastest price growth for landed residential, or is this season a faster price growth for condominiums and apartments. And the reason why prices are stable right now is definitely because of the cooling measures. And one of the reasons why price growth and price dip are not happening rampantly like in the past is also because of the cooling measure. So the cooling measure has brought on a lot of stability in terms of pricing. Prices will not see a tremendous growth at one shot. It will also not see a tremendous dip at one go. So the stability has been brought on by the 10 to 12 rounds of cooling measures, and that is the new reality that we have to face and understand. But of course, through this entire price graph, definitely one thing that we can take away is that with quantitative easing in an inflationary environment, it definitely makes more sense to invest in real estate early, because our investment horizon is also pretty much limited until the age of 65. And when we look at our loan tenure age, age. And the earlier when you enter, you take advantage of the inflationary environment. You let inflation take its own course as well to erode your debt. And that's of course one of the key strategies when you want to invest in real estate in an inflationary economy, which is where we are in right now. And thus we've come to the end of this episode on Investor Series. This is definitely a long episode where we dive into 4 different reasons, but I hope that you'll be able to extract value out of this episode. I hope to see you on to our further episodes on Investors, Buyers and Sellers series. We also have a new Shophouse series coming up. My name is Melvin Lim, PropertyLimBrothers. As always, happy to show the place. Take care. Their own housing. Everybody got their everybody task. This one got no time limit one.
This is a very long